We'd like to welcome everyone. Good afternoon. This is Kathy Livingston. Welcome to today's webinar presented jointly by DHG Healthcare and Jones Day. I am, again, Kathy Livingston, a partner in Jones Day's healthcare and life sciences practice and also its tax practice based in Washington, D.C. I'm pleased to be joined today by Amy Bibby, a partner in the DHG Healthcare practice based in Asheville, North Carolina. This is the second in a three-part series that we've been doing. Donna, could we go to the next slide? The first session we did was on February 14th, a month ago, where we provided an overview of different provisions in the new tax legislation affecting nonprofit hospitals and health systems. Today's session is going to be a deeper dive on the provisions that specifically affect the unrelated business income tax and provisions that affect compensation. We expect to talk about the siloing rule, the NOL rules, the new UBIT tax on certain fringe benefit expenditures, the new excise tax on compensation over $1 million in excess parachute payments, and then some other provisions that are affecting employee benefits like relocation expenses and employee achievement awards. We'll have a third session on April the 11th where we're going to talk about mergers, acquisitions, and other transactions. That will bring in some of the other provisions from the new tax law that tend to affect taxable entities, because we all know that nonprofit hospitals and health systems engage in a variety of different transactions and adopt structures that will often include taxables, and that will be subject matter we will approach in that third webinar. And with that, by way of introduction, I'd like to hand the floor to Amy.
Wonderful. Thank you so much, Kathy, and thank you all for being on the line again today for part 2 of our webinar series. We're excited to do a deeper dive into the changes to unrelated business income, which I will largely cover, and then I'll be handing it over to Kathy to talk through more details around revisions to compensation. I think really the key thing here that I would impress upon us all from an unrelated business income tax perspective is that we have really two kind of trains of thought here. One is certainly some provisions within tax reform that are uniquely written for the tax-exempt sector. We'll certainly cover those. And also a number of provisions, of course, that affect all corporations, all taxable corporations. And these are very sweeping changes and certainly affect unrelated business income reporting. So that's actually where we're going to start this conversation today, are changes to the corporate tax rules that also affect tax-exempt organizations alike. So, as you're all very well aware, the major theme of tax reform that certainly got a lot of coverage was the reduced tax rate of 21%. And I think it's important to clarify that reduced corporate tax rate is effective for tax years beginning after December the 31st of 2017. And so as we talk through some details around unrelated business income tax and taxable income and reporting of those things, it's going to be important that we adjust our thinking for the effective date based on this taxable year beginning after 12/31/17. I've given a brief example there under the first bullet point, just as a frame of reference, as an example for a September 30 year end. That new tax rate and a lot of these other rules that we're going to be talking about would be effective beginning in our October 1/18 through September 30/19 fiscal year. So as we sit today in our tax year, many fiscal years are still sitting in, let's call it the old corporate tax rules and old UBIT rules, and we'll be looking forward to a transition starting 10/1. And of course, the opposite is true for any calendar year-end entities. And this certainly presents some issues and considerations that we'll talk through. So there are a few other key areas and changes that really affect corporate tax broadly that I want to hit on, and one of which is the repeal of the alternative minimum tax. Again, the same timetable there for that repeal, and certainly some beneficial depreciation deduction allowances, 100% expense deduction allowance for property placed into service. And you can see some placed in service dates there of September the 27th of actually 2017, which feels really odd, and I'll explain that. And between that September date and 2023. Now, note that there's certainly some class of life limitations and some phase downs that start after 2023 that go through 2026. Certainly sounds like a long time from now, but of course it'll be here before we know it. So, in that September 27th that I referred to, the significance really of that is a bit obscure, but it's basically the date of the GOP's tax plan, the date that was revealed. So kind of gave us an extra little bit of a look back there for depreciation purposes. Also very much worthwhile noting is a 80% limitation on net operating losses created in these new tax years, so going forward. And just note that the other changes to net operating losses and how those are taken is there is an indefinite carry forward, whereas that was limited to a 20-year carry forward, and no longer a 2-year carry back. So a little give, a little take here in some of the net operating loss rules, but that 80% limitation is really significant. We're going to talk through this in a little bit more detail here shortly and see the effects that this is really going to have. It certainly has the effect of creating a gap, really a taxable gap, to create a minimum amount of tax to be paid. And the last 2 bullet points, Kathy will cover later in the presentation as well, but very much worth mentioning here that also included in this overall corporate tax restructuring that is not specific just to tax-exempt are changes to certain fringe benefits and then also moving expenses. So we're not alone in that, but it certainly does affect the tax-exempt sector substantially. All right, so on the next slide, we're going to talk some about the significant change in unrelated business income and the requirement to report that separately, or it's often referred to as the siloing of unrelated business income lines. So effective for the same tax years beginning after 12/31/2017 that we talked about, exempt organizations on the Form 990T can no longer net the loss from one unrelated business activity against income from another. And we talked some about this in the first webinar. And we're going to go through some details here and some considerations that I think are going to be very applicable and certainly have gained a lot of conversation in the tax-exempt space. So that effect, of course, is kind of a siloing or grouping. What we don't know yet is how distinctions among those activities should be determined. We certainly will talk through some possible scenarios. Some of it's somewhat of a guess. Certainly a good guess as to, how activities could be considered to be one combined business activity. And what we do know is that we have a commitment in the IRS's priority guidance plan that was issued back in February, early February of this year, where they list quite a few issues that they intend to provide further guidance on prior to the end of June of this year. That could be in the form of notices, perhaps not a lot of formal regulation, but some guidance. and the siloing effect has been one of the items that they do expect to provide more guidance. So certainly more to come, but we're going to move forward with some further discussion that I think will be important for planning purposes. So let's move forward to the next slide. So as we look to the changes to net operating losses, again, you know, the net operating losses have to be computed for each business line and carried forward only to that business. Net operating losses arising in tax years beginning before the turn of the year can still be used to reduce the cumulative or aggregate unrelated business taxable income going forward. So again, it's almost like a grandfathering concept where, and we'll talk a little bit about an old NOL versus a new NOL. That's more of a terminology that I'll use just to facilitate this conversation, but there certainly is a grandfathering of old and net operating losses to be offset against future income. Of course, we've talked about the carry back and carry forward changes that are bulleted there again, the 80% limit, and tracking those separately. Really, the overall effect of this tracking, you know, once all of the old NOLs have been used up, and certainly in the interim, the effect will be a need to certainly separate tracking of net operating losses by business lines going forward. So, you know, we can certainly anticipate having not just one NOL schedule, but multiple NOL schedules for old NOLs and NOLs from future net operating loss generating activities. So multiple schedules, presumably, that will have to be kept for, you know, any 990T filer. So one kind of key takeaway here from the net operating loss perspective that I think is important is, you know, we certainly have the for-profit sector that is certainly subject to the 80% limit. That certainly flows through to the Form 990T in the application of a limit to the tax-exempt sector as well. So we certainly have that feel and that effect. So certainly that kind of effect, but I would just reiterate that the tax-exempt sector has, I would call it almost a double whammy of not just the 80% limit, but then also the siloing of business lines, that siloing having even a greater effect to the tax-exempt sector. So with that, on the next slide, we'll begin to look at some examples or really common scenarios in the tax-exempt hospital and health system space where we typically kind of operate from a unrelated business income perspective. And of course, these numbers are try to keep them super simple and small and easy to understand and compute to help navigate the examples. So prior to tax reform and really in effect prior to tax years beginning on or before that January 1st, 2018 date, unrelated business income was really as simple as taking that gain or loss bottom line, netting it together to come to an unrelated taxable income of $18,000. So you can see certainly those three activities that, you know, the expenses outweigh the income, or for example on the lines related to investments that are held in either, let's say, for example, real estate ventures or healthcare joint ventures, where most commonly that's going to be a K-1 that reflects that net number. The netting of that to a large extent, you know, has resulted in this example, a net unrelated business taxable income of $18,000. So let's move forward a slide And let's look at what this would look like for tax years under our new reform. So again, for a calendar year, we're kind of sitting in that space now. And for fiscal years, we're probably entering into our next tax year for which this scenario would be effective. So of course, same business lines here. And in this scenario, I'll call this the first scenario, and we'll go through another one. If we look at each of these gains and losses separately, really under the new rules, the UBTI pulls down only income-generating activities. And so you can see significantly more unrelated business taxable income of $30,000. Now, of course, in this example, we're not doing any combinations of similar business lines and those types of things. We certainly feel that some of that's going to be allowed, and we'll see a possible scenario of that shortly. But let's consider this very super conservative and see those loss-generating activities kind of remaining where they are. And again, pull down those income-generating activities. And the income, of course, is a good bit more. So in the next slide, what if some of these activities can be combined based on investments held? You know, there's certainly an underlying question there as far as, you know, to what extent investments can be grouped and to what extent there is going to be any required look-through to the underlying business of those investments. Let's say for purposes of this example, we're able to net those real estate and healthcare together. Our non-patient activities, perhaps, lab and laundry, provided healthcare-related non-patient activities, and then you'll see some retail-type activities, some D&E and pharmacy. And so, you know, just a quick snapshot here of this look on the next slide, we can see what this looks like as we combine those. And of course, that result with the grouping is a reduction in the taxable income pretty significantly. You know, in this example where the numbers are kind of small, $30,000 of taxable income down to $19,000 of taxable income. So all of that to say it will be a important conversation and consideration to give to how grouping can be done, should be done, and again, we certainly expect further guidance on what could be considered appropriate for grouping. Now, I would pause here just to say the interesting thing here too, based on some of these scenarios that we've seen, you know, we have an outlying kind of question or conundrum right now as to, you know, how do we go and move forward with making estimated tax payments. Again, especially for our 12/31 year ends, that first quarter payment is coming up due soon. So certainly some dialogue around positions to be taken, largely around that grouping concept and how to look at this from an estimated payment scenario. In this, it's, you know, do we make estimated tax payments on $30,000 of income or $19,000 of income? So let's move forward with that and really looking at continuing with the same business lines. Let's layer on the changes to our net operating loss rules. And so we have a number of activities, again, some with, that have lost money in this year of example, some that have made money. In our prior example, that reduced or produced taxable income of $18,000. Now, in adding on this layer, let's assume we have a prior net operating loss of $50,000 that has been generated over a number of years. So we have that in our back pocket, and super simple math, you know, again, without reduction of that $18,000 of our, or using of our net operating loss, it really eliminates our unrelated business taxable income. Now, there certainly is another layer of this discussion. We're going to keep this example short and sweet, but there certainly is another layer to this type of analysis when a 990T filer is subject or has been subject to our prior alternative minimum tax rules. So there certainly is another layer of conversation there, but we're going to keep this example kind of simple. And under our quote old tax law, we would have $32,000 of net operating loss available for next year. And let's fast forward to the next example on what this looks like under our new rules. So again, we've got some key kind of bullet points up there at the top to remind us about offsetting is kind of that same siloed feature, our 80% limitation, and this tracking concept of old and new NOLs. So in going forward with our new treatment in our new tax year, again, we have siloed or grouped together our activities that are deemed to be similar in nature, and again, our unrelated business income going forward may look more like $19,000 of taxable income. Using that same prior net operating loss of $50,000, we're only able to offset 80% of our taxable income. So simple math, 80% of the $19,000 gets us down to that net operating loss available. And so we have some carry forward of the $34,800 available to carry forward to the next year against all UBI. So here's where in our little thought bubble we start to really compute our separate lines of net operating losses. We have our old net operating loss carry forward of $34,800 we'll be able to continue to use against that net taxable income. But note the circle around is supposed to be on the negative 1,000. So that loss from our parking, that new loss, we have to carry that forward as, we'll call it our parking net operating loss. And of course, that $1,000 loss can only be offset against future income from parking. So you can see our beginning net operating loss carry forward. We have two. We have a $34,800 and we have a $1,000 NOL tracking forward to subsequent years. So again, certainly some issues around tracking and whatnot, but hopefully that helps with clarifying how those net operating losses really have a substantial effect on the bottom line. And with that, I'm going to turn it over to Kathy to talk more about some of our changes to fringe benefits and compensation.
Thank you, Amy. And we'll start with a provision that's sort of a segue because it has been placed in the unrelated business income tax, even though it's a tax on amounts that are paid rather than what you ordinarily find in UBIT, which is a tax on inflows or net revenues. This is new Section 512A7 of the Code, and it requires tax-exempt organizations, generally exempt organizations that are subject to UBIT. So you're going to think of your 501c3s, your 501c4s, also very clearly state colleges and universities are subject to UBIT. Exempt organizations that are subject to UBIT must include in their unrelated business taxable income amounts that they pay for certain fringe benefits. So that's right, you have an amount that you're computing that is otherwise taxable income, and you're going to add to it amounts that you are paying out. And they have to meet two criteria. They have to be not deductible payments if they were being made by a taxable organization, and they have to be a payment for one of the specified types of benefits named in 512A7. Those are qualified transportation fringe benefits and amounts paid for a parking facility used in connection with qualified parking. So if you as a tax-exempt employer are paying to purchase transit passes to distribute to your employees, or paying to put a commuter bus or van on the road and offer them rides, or paying a third-party parking operator for their access to a parking facility that's proximate to work or to where they're going to pick up transit, or you're paying them a reimbursement for bicycle commuting, or if instead of handing out these benefits, you're reimbursing them under an appropriate qualified transportation fringe benefit plan for expenses for these kinds of benefits, then those payments would be subject to UBIT. Similarly, if you are making payments for a parking facility that you use, the language is in connection with qualified parking. So that would be a facility that is used at least in part to offer qualified parking to employees. Interesting question, if you're making payments for a facility that's used not only for employee qualified parking but for members of the public or for students or patients or others to park, does that result in some kind of allocation or apportionment of the expenses? The statute also makes reference to payments for on-premises athletic facilities, but those payments remain deductible for taxable organizations. And a member of the IRS Chief Counsel's Office has said twice now in public speeches that if an exempt organization makes a payment for on-premises athletic facilities, that payment would not be subject to UBIT, because even though there is this reference in Section 512A7, those payments remain deductible for taxable organizations, and you have to meet both criteria to trigger the UBIT tax. Similarly, payments for entertainment expenses are generally not deductible for taxable employers any longer as a result of the changes made with the tax reform law, but those are not subject to UBIT because they are not referenced in 512A7. There have been some questions that have arisen if an employer has a qualified transportation fringe benefit plan. Under those plans, an employee may be able to elect, I would like parking, or I would like transit passes, or instead I'd like to take cash. And questions have arisen, well, what happens if an employee makes an election to take a transportation fringe benefit under those circumstances? It does seem that the employer is then still making a payment to provide that benefit. And the thinking as we've discussed it amongst ourselves and I've heard from colleagues is that the employer making that payment, even though the employee has made this election, would similarly be subject to UBIT. This is a provision that has not been added to the priority guidance plan as a priority for guidance. It seems that the government does not see as many questions or issues here, but they are inviting comments and questions on anything in the new law. So if you're aware of particular questions about fringe benefits and UBIT, they are all ears to hear what they should do to help resolve them. Next slide, please. Now we're going to talk about the new excise tax, which is applied at the 21% rate on compensation over $1 million or excess parachute payments paid by exempt organizations. The first question is, which exempt organizations are subject to the tax? Because liability attaches to the exempt organization itself. It's clear under the statute that organizations that are exempt from tax under Section 501A alone, so if you are purely a 501c3 or a 501c4 organization, or for that matter a C6, C7, those organizations would be subject to this tax. But questions have arisen about what are called dual status organizations. There are a certain number of governmental entities, sometimes they're colleges and universities, sometimes they're hospitals, that are eligible for exemption under 501c3 and have sought and received a 501c3 determination letter, but would not be subject to tax even if they didn't have the determination letter. Over the years, some of these entities have discovered that having a determination letter is a convenience. It can help them if they're applying, let's say, for a private foundation grant and they have to prove that they're a public charity. It may have been helpful if they were establishing a 403B retirement plan, but it was not necessary for them in order to achieve exemption from income tax. So a question has arisen, if you have a dual status entity, does it have to pay this tax? We have some reference points because we know how dual status entities are handled for some other purposes. We know that there's a long-standing revenue procedure that says dual status entities do not have to file Form 990. And we know from the regulations under Section 4958 that dual status entities do not trigger the taxes on excess benefit transactions. But we also know from late last year that there was a dual status hospital that had a 501c3 exemption that intentionally triggered revocation during the course of an audit with the IRS because it didn't want to have to be subject to 501R. And dual status hospitals are subject to the 501R requirements. And so in order to get out from under those requirements, it needed to basically sacrifice its 501c3 determination letter by intentionally doing things that would no longer qualify it for 501c3 status. So there is somewhat of an open question here about dual status entities. There is also an interesting question that academics have been debating about entities that have their income exempted effectively from income tax under Section 115 of the code. You'll find any number of public hospital districts and hospital authorities that fall into this category. And would they or would they not be subject to the tax? There is a reference in Section 4960 to entities that have their income excluded from taxation under Section 115. So by the terms of the statute, they should be subject to it. But then there are some other entities that are purely integral parts of the state. They're not listed in the statute, and it's quite possible that they're not subject to the tax at all. So if you are not a purely private institution, there may be some ambiguity about the application of the tax itself. The next question is, who is a covered employee? Because the tax applies to remuneration over $1 million or excess parachute payments paid to any covered employee. The statute defines covered employees as the 5 highest compensated employees for the current year and anyone who is a covered employee for any tax year beginning after December 31, 2016. Note that's 2016, not 2017. So you'll have to take a look at who were your 5 highest compensated employees for the tax year that began maybe January 1, 2017, or maybe somewhere in the middle of 2017, because that's going to establish someone's status as a covered employee. And next slide, please. One thing that we know about this statute is that once you're a covered employee, you're always a covered employee. So just looking at this simple example, if we assume that when we talk about the 5 highest compensated employees, we're going to look at their W-2 pay, and that would be consistent with how the reporting is currently done on Form 990, where the reporting is based on, of the 5 highest compensated employees, reportable compensation, which is taken directly off of Box 1 or Box 5 of the W-2. If we use that same approach, then if we look at 2018, we see we have 6 employees here, and just looking at that W-2 pay, we would have A through E as covered employees. F, who's number 6 based on this scale of compensation, would not be a covered employee for 2018. When we then look at the amount of compensation that exceeds $1 million, we see how much excise tax is owed with respect to each one of these individuals. If we then move to 2019 and again pull the W-2 pay as is done for the Form 990, you'll see that employee A has dropped down. Used to be the highest paid and is now at $1.2 million. Maybe this was a terminal year and this person retired in the middle of this year or stepped back from senior responsibilities to a less significant job, but their compensation has gone down so that now B through F are the 5 highest compensated, but because employee A was a covered employee for 2018, employee A remains a covered employee for 2019, and so some excise tax is owed with respect to the amount of compensation that exceeds $1 million. So keeping track of these individuals will be significant in order to make sure that the right amount of tax is paid, and it may be more than 5 people in a given year. Moving to the next slide. remuneration, which is the term in the statute that it forms the base for the tax, includes all wages and all amounts that have to be included in gross income. So when you're talking about deferred compensation where Section 457F will apply, you include amounts that are deferred at the time that there is no longer a substantial risk of forfeiture, essentially when they vest, not necessarily when they're paid, because they may vest ahead of when they are paid. So there's the possibility of including amounts in remuneration for this tax, even though the employee has not yet had a distribution of the cash. Designated Roth contributions are excluded. And most importantly for hospitals and health systems, remuneration does not include payments to a licensed professional for medical or veterinary services. Now, one of the conundrums here is whether remuneration and compensation are the same thing. As already mentioned, on the Form 990, we're looking for the 5 highest compensated employees, and we do that off of reportable compensation, which we pull off of the W-2. It seems like more than a coincidence that Section 4960 is looking to the 5 highest compensated employees. Very likely that's informed by what the practice has been for some time now with Form 990. So it seems reasonable to expect that the 990's approach to determining who are the 5 highest compensated would continue to apply, but we don't yet have that confirmed in guidance. If we turn to the next slide, this is just a snapshot of the part of Schedule J where you are reporting that compensation. As you know, you report compensation in both Part 7 of Form 990 and on Schedule J. You will, on that Schedule J, report on the one little I line, the compensation from this particular organization, and then on the 2 little I line, the compensation from related organizations. That's really significant because all of the remuneration has to be included for purposes of the 21% tax, and that includes remuneration from any related person or governmental entity, and a related person could be a for-profit entity, like a for-profit subsidiary. That leads to another really interesting question, because the statute says that if remuneration from more than one employer is taken into account, presumably in determining whether compensation or remuneration exceeds the $1 million threshold, quote, each such employer shall be liable, unquote. Well, what if in rolling up the remuneration from all the related persons, you're going to include some remuneration that was paid by a taxable subsidiary? Taxable organizations are not subject to Section 4960. So what does it mean to say that each such employer shall be liable if one or more of the related persons who is an employer and is responsible for some of the compensation is a taxable entity? When looking at the kinds of compensation that may be included or may be relevant or may seem likely to put people in the ranges where this tax would come into play, certainly look at cash pay, signing bonuses, supplemental executive retirement plans, severance pay, retention bonuses. There may be other kinds of deferred compensation beyond this list, but all of them have this potential. The tax is unlikely to make the difference between paying or not paying a particular person, a particular structure of compensation, but it has the potential to significantly change the economics. So it's the kind of thing that you'll want to take into account as you're working through a pay package or potentially recruiting someone. On the next slide, here's another question about how this works. We all know that we report compensation on Form W-2 based on the calendar year, irrespective of whether the employer is on a different taxable year. And when we report on the 990, we take compensation off the W-2 that ends with or within the taxable year reported on the 990. So you can still use the calendar year comp when you're reporting on the 990. But the statute for 4960 has this excise tax applying with respect to the remuneration paid for the taxable year with respect to employment. So if we flip to the next slide, let's say that you have somebody who is employed in both 2018 and 2019. So here you see the 2 calendar years, and highlighted in yellow is the taxable year for that tax-exempt organization. is the government going to require that we pull out the two W-2s and allocate part of the 2018 W-2 to this taxable year and part of the 2019 W-2 to this taxable year in order to come up with the remuneration for the taxable year with respect to employment? That would be a significant amount of additional work and would raise all kinds of different questions. What if you have a bonus that's paid at a particular moment in time? What if you have benefits that accrue over the course of the year but are paid at a particular time? What if you have amounts that are going into a retirement plan in a particular pattern? How would you do that kind of apportionment or allocation if you had to do it? It would be terrific if the government would offer at least a safe harbor that would allow us to continue to use the W-2 compensation for purposes of paying this tax, even though the reference in the statute is to a taxable year. Next slide, please. This is just to illustrate for you that in designing deferred compensation arrangements, this tax, if you have very highly compensated individuals, is significant enough that it's worth taking into account as you're structuring the arrangement. Just to look here at a simple example, we're talking about an executive who has a supplemental retirement plan. If we have cliff vesting and we want to give them $1 million and it all vests at the end of 5 years, because we then have so much excess over the $1 million threshold, we have $900,000 worth of pay subject to the 21% excise tax. But if this had been structured instead as vesting over a 4-year period in equal installments, we would significantly decrease the amount of total compensation or remuneration for purposes of this statute that is above $1 million. So you can see it's a significant difference. It's tax on $900,000 versus tax on $450,000. That's just food for thought that as you're structuring deferred compensation arrangements, it's worth taking the tax into account if you're getting into the 7 figures. Just a caution, you would want to consult with somebody who's quite knowledgeable about the tax rules affecting executive compensation if you are obviously structuring an arrangement, but if you are making changes to an existing arrangement, because there are counterintuitive and adverse consequences that could potentially arise if you, for instance, delay vesting as opposed to potentially accelerating vesting. On to the next slide. Here's another question. What happens if you change employers within a family of organizations? It's very common in hospital systems to have a parent organization and a variety of subsidiaries. The way the statute reads, an individual is a covered employee of an applicable tax-exempt organization. And remember, once you're a covered employee, you're always a covered employee of an applicable tax-exempt organization. Well, what happens if you change employers? So on the next slide, let's say that you start out as an employee of the hospital. And on the hospital's payroll, you're one of the top 5. Maybe you're the CEO or the COO or the Chief Technology Officer. You're performing a very significant administrative role, not medical services, and your compensation is high enough that you're one of the top 5. Next slide, please. What happens, though, if we move you so that you become an employee of the parent instead? I'm sorry, Donna, can we go back and have where the box that shows that the individual is an employee of the parent? Oh, did we lose that slide? There we go. Oh. If the individual is an employee, moves over to become an employee of the parent and has their services instead assigned to be provided to that hospital, the question is whether they lose their covered employee status. If they stayed employed by the hospital, they would stay a covered employee forever. But if they become an employee of the parent instead, because that's a different applicable tax-exempt organization, would they then lose that covered employee status if there were at least 5 other people who are more highly compensated? So that's an interesting question as well. Medical services. What are medical services? There's no definition in the statute or the legislative history. A common example that we've been hearing from clients is that you have a very senior level official, maybe the CEO of the system, who is a widely respected, long-standing medical professional, and they want to keep their hand in patient care. And so let's say they see patients in clinic a couple of mornings per month. their contract, their employment contract, makes no reference to this clinical activity. They're being hired to be CEO. Their position description is to be CEO. It may include things like other duties as assigned, but doesn't make any specific reference to medical services. But in fact, this CEO is doing something 2 mornings a week that is clearly the provision of clinical services to patients. Seems, by common sense, to be medical services. Is it possible to back out a portion of their compensation attributable to those 2 mornings a month? We don't know. Going forward, if you are hiring somebody who you think is going to be a covered employee and you think this is possibly the way their work life is going to play out, do you want to put something into their contract to explicitly call out this medical service activity so you have a shot at making the argument? That might be a strategic move to make. Next slide, please. Now switching from that 21% excise tax to some other compensation and benefits-related issues. This one, Amy and I were discussing just before we started, has been getting a lot more discussion and attention from clients than we might have predicted. The tax reform changes have eliminated tax-favored treatment for relocation expenses. So the deduction for moving expenses that was available through the end of last year is no longer available for this year through 2025. And those are expenses for the travel and the lodging and the moving of household goods associated with a move of some distance. It also eliminates the exclusion from income and the associated elimination of tax that used to happen if an employer paid or reimbursed these moving expenses. So if the employee, the newly hired employee, presented the employer with the bills and said, could you please reimburse me, and the employer paid those bills, the employee was not treated as having income as a result of the reimbursement. This change to the exclusion is effective for a similar period of time through 2025. One thing to note that often happens when there's relocation of a medical professional is a discussion about tail coverage for malpractice, and this may often be offered as part of a relocation package that the new employer will pay for tail coverage to cover the prior position and the medical services that were provided prior to employment. That tail coverage is generally a taxable benefit, and that, even though you may think of it as part of relocation, is not affected by the new tax law. Now, in talking with various clients and others in the tax-exempt sector who've been looking at this, it seems that relocation is such an important part of recruitment that employers, tax-exempt employers, are expecting to continue to offer to pay for moves, to reimburse for those costs. And then they're trying to figure out what are we going to do with the associated tax effect. One possibility is it's just going to be more expensive for the recruiting employer. They may have to gross up the employee to cover the tax cost associated with providing this benefit. Alternatively, if the recruiting employer is not inclined to provide a gross up, they'll want to be extremely clear with the employee that they're recruiting that in paying for these moving expenses or providing a reimbursement for it, they are saddling the new employee with a tax bill that comes with that reimbursement so that you don't have any kinds of surprises. That seems to be contrary to the dynamic that most employers are trying to achieve when they're recruiting a highly sought-after individual. So we think that the tax gross-up seems to be the more likely strategy, but it is definitely adding a cost. Another watch-out in trying to put some of these provisions together is sometimes your most highly sought-after recruits are going to end up being a covered employee for purposes of that 21% excise tax that we just discussed. You may want to keep in mind if the compensation that's going to be paid to this individual is getting really close to the $1 million line, that relocation package that includes the payment for the moving expenses, which is now going to be added to compensation along with any gross up, could be what puts them over the $1 million. So you want to be cognizant of the fact that you may have excise tax as well. You may also want to look very carefully at the calendar. This individual may not start employment until your next tax year, and therefore wouldn't be listed and wouldn't become a covered employee. Wouldn't have enough compensation to be a covered employee until your next tax year. Do you want to consider giving them the payment for relocation expenses or some kind of a signing bonus in the current tax year when they are not going to be a covered employee, so that you can avoid triggering the excise tax, at least with respect to that payment. So the intersections between these different provisions can sometimes add some extra complexity and issues that you'll want to address. Next slide, please. This is actually this is not a highly consequential provision in terms of the number of dollars involved. We're no longer talking about 7 figures. Now we're talking more like 2 or 3. But IRS agents really like certainty, and they like things that they know how to audit, and they like to look at things like awards that are given to employees. It has long been the case that there is the possibility of an employer providing a deductible Employee Achievement Award with a $400 cap on the value of such an award, and that deduction remains available. The award is not taxable to the employee as long as it's deductible to the employer. But Congress, in this most recent tax reform law, made clear that when you're talking about an Employee Achievement Award that is eligible for these more favorable tax benefits, it needs to be provided in the form of tangible property. It should not be cash or a gift card or securities or vacations or sports tickets. And you can understand, with the best of intentions, these kinds of awards being handed out as a reward to employees who've done a particularly good job. But now, unfortunately, we have a little bit of a trap for the wary. Next slide, please. If you give the gift card on the left, unfortunately, that's taxable compensation to the employee. If you give the Apple Watch on the right, because that's tangible personal property, and because the value for some Apple Watches will be under $400, that would not be taxable, and you would be able to take advantage of the special rules for Employee Achievement Awards. On the theme of IRS agents looking at these kinds of things in general, the amount of employment tax know-how available to the exempt organization's audit function has increased because they consolidated with the federal, state, and local governments group, which had agents who focused particularly on employment tax. So with that additional capacity and know-how, with the certainty that comes with employment tax, with the possibility of actually being able to collect dollars, I think you're going to find that agents will continue to be keenly interested in looking at these items, even if they appear to be small dollar. They want to see those auto mileage logs, and they want to see what you're doing with Employee Achievement Awards, and they will be looking for W-2s and W-3s, and with this 21% excise tax, they will have an added incentive to look at potentially worker classification issues, because if you have some very highly compensated independent contractors who are individuals, there could be some excise tax implications if they were in fact employees. So in this whole bundle of issues, while we're talking about things on both the planning side and the audit side, it's worthwhile to keep in mind that these will be attractive targets for audit once we get to the years in audit where these things are in effect. Amy's given some very good advice to keep an eye on where those effective dates are. But it's worth paying attention even to the small ones, because they are so attractive to the agents. When we send around the slide deck, which we will do, we will send a copy of the slides to everybody who has registered for the webinar within a few days. You will find at the back a few extras that just put you on notice, as if you didn't know already, that the IRS has put out a revised version of Form W-4 and a wage withholding calculator that employees can use to check what should be their accurate wage withholding. The W-4 itself hasn't really changed. It's the worksheet that goes with it that has some important changes. Unfortunately, we still don't have the IRS publication that goes with that that's necessary to answer some of the questions, but just wanted to make sure that we provided a friendly reminder that those things are available as well. Amy, I'm going to give the floor back to you, because I think we're now able to take some questions.
Great, wonderful. Yes, we do have a few questions, and as I'm reading out the 2 that we have, please type in any questions that you have, and we'll take as many as we have time for. So the first question is the fair market value for parking lots free to the public, including employees, includable as unrelated business income? So I think this question is if there is no cost to the employer to to allow free parking, otherwise free parking, would that be includable as UBIT?
I think the answer is that there should be no additional UBIT where, first of all, the employer isn't making a payment, because what's included in the UBTI are payments made by the employer with respect to facilities used for qualified parking. So if there's just an existing parking lot that's available for free, then there shouldn't be a payment there that should trigger the additional UBTI. If the employer is building a parking lot, which is going to be offered to employees both to give them parking and to give the public parking, then there may be some additional questions. But if that lot is going to be open for free on a first-come, first-served basis, then it doesn't really seem like there's a qualified transportation fringe being offered, because there's nothing of particular value. It's a facility, but it's available to the public at large.
Great. Great. Next question was related to the excise tax. Is the excise tax calculated on the calendar year W-2 or fiscal year?
The excise tax, the way it is described, applies, as we were reading together, with respect to compensation for the taxable year. Since it's an excise tax on the employer, it's tracking with the employer's taxable year. So the assumption is that when the IRS tells us how this tax is reported and paid, that there would be a form that the employer would use to compute what tax they owe for the employer's taxable year. But then we have this exact conundrum that your question is highlighting. Since we do all of the computations of compensation on a calendar year basis, how are we going to figure out how much the employer owes on a taxable year basis? It's an excellent question. We just don't have an answer yet.
Yep. Absolutely. And the last question relates to the corporate tax rate. So the discussion around the applicability of the reduced corporate tax rate to fiscal year filers. Do the Section 15 strata rules apply such that the 9/30 year-end organization will have a blended rate for the current year? And so I can kind of take that one. And so ultimately, with the corporate tax rate change, that is a automatic, change in that as of the first day of the new tax year for a 9/30, you would have the 21% corporate rate, whereas prior to that date, for any tax period before that, we have our current or our former tax blended rate that is, of course, the graduated rate schedule. So that blended rate would apply prior to that tax year beginning after 12/31/17. So in that 9/30 example, you really have that effect in effect for 10/1 of 18. So hope that helps on all of those questions. And thank you, Kathy, for answering those couple of questions as well. And with that, it looks like we are rounding out the hour and no further questions. On the next slide, I would just point you to the third and final Part 3 that Kathy mentioned earlier. And this is really going to focus on the changes that affect tax-exempt organizations, certainly as it relates to many of the corporate changes from a transactional perspective in mergers, acquisitions, and other entity-level transactions that affect our tax-exempt sector. So look forward to having you all back on April the 11th, and that registration will be coming soon in a similar fashion as the first two parts. So again, thank you so much for attending today. Please do not hesitate to reach out to Kathy or myself with any further follow-up. We welcome that type of dialogue and hope you all have a great rest of the afternoon.